We're glad you could join us on another edition of Business Redefined. Tonight, we want to talk about an emotive issue for many Kenyans, and that is the cost of mortgages. Now, experts contend that Kenya's mortgage market is largely exclusionary, leaving out the majority of those who would desire to have access. As at the close of 2020, there were 26,900 outstanding mortgages in the Kenyan market, with a total value of 233 billion shillings. This was a decline from 28,000 mortgages in 2019, whose value was 2.1% higher at 238 billion shillings. The Kenya Mortgage Refinance Company, that's KMRC, was established in August 2018 as part of the efforts to make mortgage facilities more accessible to Kenyans. KMRC extends loans to primary mortgage lenders to refinance loans capped at 4 million shillings in Nairobi metropolitan area and 3 million shillings elsewhere to individual borrowers whose monthly household income is not more than 150,000 shillings. I sat down with the Chief Executive Officer, Johnstone Oltetia, and the starting point of our conversation was the October 2021 ratings from GCR and what they mean for the planned bond issuance.
I think what we've gotten from GCR actually talks about KMRC. It's the model of the institution that they have looked at. They have looked at the operations of KMRC. They have looked at the setup, the shareholders and the kind of credit mechanism that we have. And that's exactly why we got the kind of rating that we have, which in our view is very good. It's comparable to any tier 1 financial institution in our country. KMRC, of course, sought a rating just to be able to manage its position in the market going forward. But it also came in very timely because of the bond that we are going to go to the market to issue very soon. So it actually helps to build the case for KMRC bond issue, which we anticipate will hit the market at the end of this year. When KMRC goes to the market to issue a bond, it's market-based. It's expensive funding. But the way we are going to achieve affordability is we are going to blend those resources. So we get the funding from the capital markets and blend with the concessional resources we have, and therefore we still push the cost down, because it's the cost of funds that determine how much you're going to lend at. So we are very confident that initially, once as we raise the bond, we blend the resources and still achieve affordability and the long term. Unlike those other institutions, KMRC is a very low-risk institution. And that's how investors need to look at KMRC. It's primarily a monoline institution, very, very, very low risk.
Heavily de-risked. Yeah.
Yes, yeah. Extremely de-risked. And therefore, the pricing of the KMRC bond will be different. But the most important thing is that market timing. We know that the ABL is currently in the market. We have to look carefully at what stage will KMRC be in the market because of the kind of rates that we are seeing in the market right now. So that will determine ultimately when we actually hit the market. While we have literally finished off the processes that we have and the taking for the issue of the bond, market timing remains a key issue that we have to consider. We are issuing a program, a medium-term note. We are looking at a medium-term note of about 10 billion. And of course, we'll issue tranches over time to raise the money that we need. So generally, that's the information that we can provide right now. We'll provide a lot more information once we get the approvals from the regulators.
So I asked Mr. Oltetia exactly what defines an affordable facility and what mortgage size is actually fitting when it comes to Kenyans who seek to tap into KMRC-enabled mortgages from the lenders to whom they receive the onward financing. And this is what he had to say.
At the moment, we are coming from an environment where an average mortgage, according to the Central Bank of Kenya, data, is about 8.6 million. That's on average. So of course, you expect that it will be a lot higher than that and a few that are lower than that. Now, we are certainly, like you said, driving mortgages down market. The rate at which, or the average mortgage at the moment that KMRC has lent to is about 3.8 million. And we expect that to even go lower. So we have a number of mortgages at 2 million, others at 3 million, and a maximum of 4 million. So even the money that we are lining up for lending, we have provided guidance that it has to be affordable, and the affordability here has been defined as a loan that does not exceed 4 million in Nairobi and Nairobi metropolitan area and 3 million elsewhere around the country.
Okay.
We have already seen that, and for any institution to qualify to get KMRC funding, they have to submit a portfolio that meets that kind of requirement. We are looking at the moment, actually processing loans worth 6.2 billion from the primary lenders.
Okay.
Now, those are about 4,000 mortgages. So we are essentially saying we are impacting about 4,000 home borrowers at the moment based on that arrangement. Now we hope and we expect that to scale up over time, so that because KMRC financing will move and it's a liquidity provider, and then that will essentially help to accelerate the developments of those mortgages over time. So we give guidance to the participating institutions to the effect that the expectation of KMRC is that we expect to retain affordability. And certainly they are receiving concession of funding from KMRC at 5%. So what we are advising is that the rate should be within single digits. And we have already seen that. For the institutions that have received financing from KMRC, they are currently lending at 9. And the focus of KMRC is to help this, to drive down the rates so that we have both low rates and longer tenors. So KMRC funding is actually 20 to 25 year money. Now, so when we are lending to the primary mortgage lenders, we have provided them with what we call an eligibility criteria, which specifies the terms of the loans to KMRC, and that includes the tenor as well as the rate. And so we expect over time that the duration under which an individual will pay a loan will increase from, I think, an average of about 11 years in the recent past to potentially 20, 25 years. KMRC may never be able to finance the entire mortgage book of a financial institution. So they still have to run with what they do currently, and KMRC will, for the time being, only pick what qualifies. They still have the larger mortgage book that they do, because remember, the market, our market, especially the formal mortgage market, has been exclusionary and extremely conservative. Now, they have been focusing on microloans and short-term in most cases, which is a situation that we want to change very soon. Exclusionary because they have been focusing on the upper market, upper market income borrowers, and that excludes the moderate low income borrowers. Now that is expected to change with the KMRC provision. That's why we are encouraging that for you to be able to qualify for KMRC refinancing, a mortgage that qualifies is 4 million and below, or 3 million or elsewhere around the country. KMRC has a very important role to play in market development as well as stability of the financial system. Now, when you look at the stability of the financial system, and that's why regulators prefer or actually like a mortgage refinance company. The stability aspect, when you look at the liability matching, KMRC provides long-term funding to the primary lenders. Ordinarily, a primary lender will lend short-term funds, which are usually deposits, into long-term investments like housing, and that's when they run into a mismatch. Now, KMRC is removing that mismatch by essentially providing the long-term funds that they'll match with the long-term investments that they are making. And that's one critical aspect of a stability instrument, because it helps the financial institutions to manage their risks better. So that kind of arrangement helps. Now, when you also look at KMRC as stability instrument, you can call it a lender of first resort, or maybe a lender of second last resort. Central bank is a lender of last resort. So It is providing liquidity to the financial system, which ordinarily is a function that the central bank does, but central bank only does it on a last resort basis. But KMRC is providing on a first resort basis, and that is part of the stability role that KMRC brings. In other cases, we have seen studies that actually a mortgage refinance company acts as a counter-cyclical instrument. Counter-cyclicality here comes in when a mortgage refinance company provides liquidity, especially when the markets have gone down. So it helps to then boost the markets because its activities increase when markets are going down, and therefore that creates stability in the financial system. Now, the shift in the pension regulations is very useful. And you may already have seen a few institutions that are doing that. Some marketing, like for example, Coop Bank is already on that. What that does is that it actually gives you equity. So you take the 7 million or 40%, they say whichever is lower, for purposes of using that as equity or a deposit to be able to buy a home. Now, if, for example, you are taking a home of 4 million, then that should be able to help you cover almost entirely the cost of that home, which is very useful. And it also helps in that offtake that we are talking about. Now, in the event that you will not be able to have sufficient cover, it gives you a contribution or a deposit for you to be able to take up the loan. And what we are doing now is that we are encouraging people to go that route, use the pension that qualifies for purposes of a deposit, and get the rest from a mortgage provider through KMRC. So for example, if you qualify, you take $1 million and the home is about 4 million, that means you've already put a deposit. The difference, which is 3 million, you can obtain from a participating financial institution, essentially at the same concession rates. And that helps a lot to get a lot more people to be able to qualify. Sometimes they say a deposit actually acts as a barrier to entry, depending on how much it is. So if people are not savers, they really don't have those deposits, they can have that deposit. And that is a key barrier to entry for you to be able to get a mortgage. So the pension unlocks that barrier for you to be able to get the deposit that you need.
And that takes us to the close of part one of this discussion on the mortgage landscape in Kenya, with a particular focus on the Kenya Mortgage Refinance Company. We shall be back with a lot more after the break. Stay tuned. Welcome back to this conversation on Business Redefined, where we are digging into the Kenya mortgage landscape with a particular focus on the Kenya Mortgage Refinance Corporation, which was established in August 2018 to facilitate the downstream movement of mortgage accessibility in the Kenyan market. We started the second part of this conversation by asking Mr. Johnstone Oltetia, who is the Chief Executive Officer of KMRC, when it comes to the mortgage landscape in Kenya, what are some of the risk factors which are largely considered by lenders who are weighing the prospects of extending credit to the Kenyan households?
It's very simple. All that you need to do is approach a participating institution and say, I need a KMRC supported mortgage. Now, we have been working with the participating institutions to advise so that they have the two products separate. And the features of the KMRC mortgage is very well elaborated to the financial institutions, to the extent that when you approach one, they should be able to see this is the expectation and the terms for the KMRC one. These are the terms for the other mortgage. And so it's you identifying the home that you need, approaching the financial institution, and you follow the normal processes. It's extremely simple for you to be able to get the qualification. Now, there are few requirements in relation to the affordable housing. That number one, in most cases, it's about the income. The income we're talking about should not exceed 150,000 per month.
That's
for affordable
per household.
Per household.
Okay.
Now, and you know what? That covers a majority of the people, because below 150 is where most people are actually. Now, you also just have to identify a house at the appropriate place, we have guided the participating institutions on what we call environmental and safety requirements. You know that the house has to be cannot be in a riparian. We're talking about exclusions. Cannot be in a riparian place, cannot have disputes, cannot have a couple of things, cannot be on the road, in a government property and things like that, which is part of essentially what credit assessment is done by a financial institution. And so we also have that as part of our requirements. And the issue is to protect a borrower, that you don't invest in a home that will potentially be destroyed or things like that, and you lose your funding. So it's actually for their own safety that we do that. So there isn't any other challenge other than the fact that you need to identify a home with an appropriate place. Once you get, then you approach, then you follow the rest of the steps that be required. Digital credit assessment approaches have been used by other countries to be able to get to the macro entrepreneurs and especially people who are not in formal employment. Now, for us to be able to reach out to a majority of the people who are not necessarily in formal employment, we need to create standards through digital credit assessment so that you can determine the creditworthiness of a potential borrower by looking at their stream of income, which is not necessarily usually consistent. But you can be able to assess and see that they can be able to meet or repay a mortgage. We are currently working with 2 institutions and looking into that. In fact, there's a study that's currently going on, which we'll make public once we have it done, to ensure that we have a mechanism for the primary mortgage lenders to be able to assess, using digital means, the creditworthiness of a non-formal employed person. And that is to crowd in a lot more people to be able to take up homes. There are a lot of people, a lot of Kenyans who qualify, who are currently macro entrepreneurs, and they can be able to do that. And the current situation is the financial institutions look at them as high risk. And that's because they lack a mechanism of determining the risk levels of those individuals. Once we are able to provide that, you expect that you create efficiency there. So that will essentially then increase the scope of lending. Now, achieving efficiency also is through looking at the approaches we have, because inefficiency which has been created especially from the environment. At the moment when you try to access a mortgage, there are challenges within the environment, especially when you look at the registration processes, when you look at the incidental costs, because you have legal fees, you have valuation, you have government access, and a couple of other things. And all those affect a mortgage, and that actually increases the cost of a mortgage. Now, so when we achieve that efficiency, which actually is currently ongoing, because you have heard of the digital processes that are going with the registrations, with the lands and things like that, and once you achieve that kind of efficiency, we expect that these rates will start going even further down, because financial institutions factor that inefficiency in the cost, and that's what, when you streamline that, then we'll expect that to move even further lower.
We asked Mr. Oltetia, is there any plan by the Kenya Mortgage Refinance Company to widen the pool of entities it is working with as far as primary on lending of the KMRC-enabled mortgages are concerned? And he gave us some insight into what are the near-term and medium-term outlook.
In fact, KMRC has set a precedence in the world as being the only mortgage refinance company that has included in its model SACCOs and microfinance. We are part of an international organization called ISMA, International Securities Secondary Mortgage Market Association. And KMRC is currently setting the trend by having a number of countries, jurisdictions, actually studying the KMRC model because of that inclusion of SACCOs. Now, the purpose of having SACCOs is because SACCOs, you then widen the outreach. And SACCOs in Kenya have been playing a very key role in housing. They lend, personal loans, but most of those loans actually go into housing. They do incremental housing development. You get a plot, you start developing through a mortgage, of course, through a SACCO. Then you start developing it over time, and that's the incremental housing development that's taking place. At the creation of KMRC, that was recognized, that SACCOs play a key role. The other one is diversity. So we're actually now creating diversification in our market because we have players who have not traditionally been part of the mortgage market, who are SACCOs. And that also creates competition in the market. And maybe that's why we are hearing those sentiments. Because we expect a lot more competition. We expect a lot wider reach of people for them to be able to get mortgages. And the competition especially is critical for a home borrower. Every home borrower would like a situation where there is sufficient competition in the market. And that's what KMRC is creating. The 6.2 billion is, we have 11 borrowers, 11 financial institutions have primary mortgage lenders, yes. So we have 20 of them, 11 have so far are borrowing from KMRC, and we expect the rest to come in very soon. So we are setting precedents. Yet KMRC is a small institution, but we are actually setting precedents. Our market is dynamic, very, very dynamic compared to a majority of the market, especially in Africa. Now, that talks to the kind of market we have, which is fairly developed and considering various issues, like the way our market sat and decided that for purposes of this to develop further, we need SACCOs, we need microfinance. So the take home from here is that we have a good story to tell the world. And the further we develop our market, the more even practical you'll see a lot more jurisdictions coming to benchmark with us. We already have, I think, 3 jurisdictions that be calling on us, comparing notes. A couple of others who are part of the association or the international association we are in always compare notes. And of course, we also compare notes with them. And we refine our practices based on those benchmarks that we do. But we are pushing a good story in our country, and there is a whole dynamic nature of the country that gives a very good story about it.
And that takes us to the close of our conversation on the mortgage landscape in Kenya, with a particular focus on the Kenya Mortgage Refinance Company and the efforts by both state and non-state actors to facilitate access of mortgage facilities to the majority of Kenyan households, particularly with the growing emphasis on the affordable housing agenda. Remember, the loans are sized at 4 million cap in Nairobi metropolitan area and 3 million elsewhere in the country. And we've just walked through some of the issues you need to consider when you want to tap into this KMRC mortgage facility. Stay tuned to Business Redefined for more insights on matters regarding the mortgage landscape.